Hello and welcome to this episode of Akrinos Access. I'm your host, Eric Matei, joined today by Evon Mendrin. Evon is the principal and founder of Optometry Wealth Advisors, a financial planning and wealth management firm specializing in working with optometry, and Evon, certified financial planner, certified student loan planner. Very excited to have him back here on this episode that Evon, I know we were talking a bit here the last few weeks leading up to this. This is going to be a pretty far out concept we're going to unpack.
I'm excited to be back, Eric. Thanks so much for having me on. And this is a concept you and I have talked about. This is something you were on my podcast recently. We brought up this concept in that conversation. So I think it'll be fun. I'm excited.
The concept being looking at your practice as an asset, right? And really what this all kind of ties back to is realizing that, well, if you own a business, you're not just going to want to be owning your job, but you're actually want to own this living, breathing entity, this economic engine that has value, right? And as it were, when we look at how many doctors these days approach investing, approach their practice, so really far out insights coming out of just kind of changing that perspective a little bit and how we factor the practice into that broader financial plan and allocation of resources. So, Evon, what do you say we start and take it at the top, and let's just maybe start by defining some key financial terms.
Sure.
Just
get the very basics. Yeah.
Absolutely, man. Yeah. So maybe just for starters, let's just talk about like assets, liabilities, equity. Maybe start kind of high level looking at finance.
Yeah, I mean, what is an asset, right? It's something you own for future production or for future return. It's something you own that you expect to give you some benefit in the future, hopefully higher than it costs to buy the asset itself, right? And the liability, what's a liability? And these are all things like if you're a practice owner, you're going to pull up a balance sheet and you're going to see all these different things on there. A liability is something that you or your business owes to someone else. And it could be debts. That's the most common form of liability. But there's also things like taxes that should be paid but are not yet paid. Those can be liabilities, or retirement assets that should be sent to employees' accounts but are not yet. So even stuff like that can be owed. But a liability is something you owe. And what's equity? Well, equity is what's left for you, the owner of the asset, after the assets are sold and the liabilities are settled. What value is left for you as the owner to keep? What do you actually have a claim on? That's what the equity is representing.
Yeah, but what's fascinating here is to look at value in the context of kind of the broader financial plan, and that the way you value the practice maybe differently from how you're going to value other assets in the portfolio. So why don't we unpack a little bit about that? Just like around this concept of value, book value versus fair market value versus other ways of valuing assets.
Yeah, I mean, there's like book values. Again, you pull up the balance sheet, you see the book value. It's sort of the equity there. It's literally you have the assets of, we're talking about the practice. So let's say in the practice, you have the assets of the practice, subtract out the liabilities. That's sort of the book value of the business, right? What could you get if you just sold everything in the business? Which is different from a fair market value, because a fair market value is really like what would something sell for on a market, on an open market? Like what would a willing buyer and a willing seller be willing to transact a business for? And that includes a whole lot of other things. It includes all these intangible parts of a business, all of the employee knowledge, the processes, the branding and marketing, like all of that intangible stuff that goes into the profit, whatever generates the profit of the business year in and year out. The fair market value should include all of that stuff. And it's going to include not only the equity of the assets, but also the expectation of future profit that you would get if you were to buy the asset. So the fair market value is going to include all this intangible stuff that goes into what makes that business profitable that you're not going to see on the balance sheet. Unless you bought a business, then you might see goodwill and other intangibles on the balance sheet. But yeah, so they can be very different.
Absolutely. And I think what's fascinating here, and perhaps you can speak to this as well, Yvonne, is that when we look at other assets that the practice owner may have,
Yeah.
right? Whether it's real estate, other investment accounts, qualified or not. How do we generally value those assets? Well, it's kind of more like you go check your account and see what the balance is, right? And
Yeah.
depending on what that account is,
Right.
um,
Right.
will dictate how frequently one is kind of exploring the value of it. But
Yeah.
absolutely, as it pertains to asset allocation, right? Like you're going to want to kind of have an understanding. And I suppose this is where I'll ask you is, financial planner, right? If you're advising someone on where to put their resources, the degree to which value, but also that ROI is going to certainly have implications and time horizon and other things we'll get to here shortly. Why don't you comment a little bit about that? When we're talking about this concept of value and looking at the practice, you've got book value, you've got fair market value. Let's maybe talk about value of some of these other assets.
Yeah, I mean, so I mean, you have different type of assets, right? You've got these retirement accounts or non-retirement accounts, things that hold these liquid investments like stocks and bonds, like stuff that are on a market that changes throughout the day, and the prices are constantly reflecting the activity throughout the day. So the value of those assets are going to be supply and demand. Basically, the buyers and sellers are interacting, and these prices change throughout the day to adjust for that. Still implicit in all of that, though, is going to be the same fundamentals. It's whatever the equity value of that business is, if it's a stock, plus the expectation of future earnings. I mean, that expectation of future earnings is still implicitly held inside of the price, but you're just going to see it fluctuate throughout the day, much differently than your practice. You don't have a thousand buyers and sellers offering to buy and sell your practice day in, day out to give you a market value. But you're going to see that reflected. The prices change, throughout each and every day. Real estate, for example, real estate's another one where if it's rental real estate, think like your commercial property, the business, even a rental property elsewhere, like the cap rate, a lot of that value is still going to be driven by what profit you can get from owning that real estate, which is different from a residence. Residence is really going to be determined by local comps or whatever that local neighborhood market's selling similar houses for. So it's different when it's a rental property, but still sort of inherent in that is going to be what could a buyer expect to get as a result of renting it out and producing that income. But even then, you're going to see that really when you're trying to either buy or sell it. That's really where the fair market value starts to become much more solid.
Yeah, so I like how you brought up the concept of return, right, and
Yeah.
income, because I think that's an absolute. Let's maybe take the conversation in that direction, talking about return on investment, right, and
Yeah.
realizing that, to your point, future expectations, future earnings expectations definitely impacts value today,
Yeah.
right? But also from the standpoint of looking at the practice as an asset, that's also an income generator, right? So let's talk a little bit about, ROI, how to calculate ROI, maybe kind of from a high level.
Yeah, like what is return on your investment? Well, it's the growth, it's the return that you're going to get for the investment you have. So on a really easy level, let's say you own, again, a publicly traded stock, as most people kind of at least can think about the concept there. Like you buy something for $100, it goes up in value by 5%, you get a 5% dividend. So your total return is 10, and you can divide that return by the original investment, 100, and that's sort of your return on that investment, right? So you take whatever total amount of return you get by whatever way it comes, you can divide that by your initial investment, and that percentage is your return on investment. That's the return that you're getting for owning that asset. And it can look different ways for different types of assets. Your practice can get a return on that investment as well. Your practice is going to give you a return in two different ways, just like any other business that you can own. It's going to give you profit and cash flow, which you can then take and reinvest either back into the business or elsewhere. But it's also, like we've been talking about as well, it's an asset on your balance sheet. I mean, it holds some value. I mean, we don't know the stage of which you're in the business depends, is going to determine that value in a lot of ways, but it's going to have some amount of value as an asset on your balance sheet. So the growth of that value is a part of the return that it's getting you. And so the return on a practice is going to include both the growth, which is sort of hard to determine until you're actually going to go and sell it or get it valued, as well as the distributions and the profit that you're able to get from it. And there's a return on equity formula. I mean, you can sort of use, assuming your books are accurate, you can sort of use a return on equity formula to figure out what is your return that you're generating as the owner of the business, not necessarily just as a practitioner, but as an owner of the business, as a shareholder. You can sort of determine that by using a return on equity formula there. And real estate's gonna, you look at real estate, well, it's gonna give you, you're gonna have similar inputs, right? It's the growth of the real estate value plus whatever profit you're getting for renting it out. That's what's gonna determine that return on investment.
Yeah, it's fascinating as you're bringing that up to consider at various milestones across the practice, right? And we're speaking here particularly for practices that are a bit further into the process. Think, probably hitting about that 5 to 10 year mark. As a matter of fact, for our viewers out there, Evon was on a prior episode, actually, of the Cold Start Corner, where we talked about tax implications. To kind of hitting that 3 to 5 year mark, where your cold start typically is going to start generating some really great income for you. But to put it in context here, looking at for various milestones across the practice, right? Most notably, hey, I'm ready to purchase my own office, move out of this lease, purchase an office. Hey, it's time for me to add an associate, make that associate a partner, and perhaps even smaller milestones, such as just like, hey, should I build out that 4th unused lane? Is it time for me to make the investment and really build it out, or perhaps add the specialty? But as it were, Evon, on this whole concept of return on investment, return on equity, the degree to which I believe now we have access to so much data around consumer behavior, around public health need, around cost of making these decisions, that you can really be really strategic with some of these in a way that could really position you for some really amazing outcomes, right? And it all ties back to ROI, right? As you mentioned a moment ago, Evon, you can go into various accounts and kind of calculate that ROI pretty simply, and check the account, see the value of it, understand how it's time to dump that stock, time to invest in this. But to encourage folks to perhaps look at the practice in somewhat the same way.
Yeah, I mean, let's talk about this point of like, why is it important for someone to think about owning this practice as an asset rather than just a source of income? And I think there definitely is sort of a mindset change or difference when you think about it. I own an asset that produces income that covers my living expenses, versus I've started this business as sort of a way to just cover my expenses. It's just sort of a job. It's a way to produce cash flow. There's a difference in when you see your business as an asset that you own that produces income, then you can look at all those decisions like you talked about in the business of, should I make this reinvestment decision? Should I start to do these different things to put dollars back into the business? And it's not just how is this going to increase my income? It's how will this improve the value of this business? And even decisions like de-risking the practice by adding associates or making it in many different ways less and less reliant on you as the owner on the day-to-day operations. Like, those are ways to preserve the value of the asset as it's growing and making it maybe more marketable. So you start to look at these internal business decisions a little differently when you see it as an asset that you own that produces income for you, rather than just it's your job. And I think even just like when you're cold starting, okay, there's not a whole lot of value in terms of the asset itself. I mean, even literally you might have negative equity in the practice, but you can at least see that as this is an entity that I own that I can invest into and improve the value of over time, and allow yourself to be patient by seeing the growth of that assets just like we talk about the long-term patient growth of all of the other assets on your balance sheet. So I think that mindset difference is really important. And from a financial planning perspective, it's important too, because that value on your balance sheet, on your personal net worth, is a part of planning for financial independence. And that value is impactful. It's meaningful in some way. Now, it's hard to know, again, with certainty what that is as we're getting closer, but as it becomes more and more certain, that it's definitely impactful in becoming financially independent, as well as from my perspective, it's also seeing how much optionality do you have in your net worth as you get closer to financial independence. Because if all of your net worth is in the business asset and you have no balance in other types of assets outside of that, you don't have much optionality or flexibility when you get to that point of retirement. So for many financial planning reasons, the thinking of that as an asset that you own is important. I mean, what are your thoughts, Eric? I went on a monologue there, but what do you think about all that?
Well, no, absolutely. And actually, this is a perfect tee up to kind of these next two topics that I wanted to touch on here. And that is taxation and time horizon, right? Because to your point, Evon, all of this, running and growing your business, this asset, right? Again, it's got to be complementary to really your big goal. What is the big goal, right? What is that? And I know, Evon, this is where the work that your firm does is all about the big goal, right? Yeah. Of financial independence, but as it were, to make strategic decisions. And that's really, and by the way, viewers, that's really what kind of teed off this episode a couple of months back. Yvonne and I were having this conversation, and the degree to which we believe that now modern practice owners can leverage data and all this cool stuff that we can bring together to really make informed strategic decisions, that sets everyone up for success. And I think when we look on our end, Akrinos, more operations, right? Because we're all about the profitability of the practice, achieving these major milestones of the practice, the strategic plan, the modeling and feasibility analysis to achieve it, right? And then from your standpoint, where the practice is one of a variety of assets in this much, much bigger, broader plan, again, whether we're looking at it as an income generating vehicle, return on investment now during these working years, and certainly the value of this thing over time and what you're going to have when you get to that point. So on that note, Evon, let's talk a little bit about tax and taxation of different investments, because I think that's something also what's interesting about the business, as with other investment vehicles, is that these tax considerations must be taken into account when making these big strategic decisions.
Yeah, I mean, this is a huge, broad topic, right? So we're going to speak very generally here and just sort of like talk with your professionals about your tax situation, right? Because these are very, very, very high level. But we think about the taxation of these different assets. Okay, let's talk about your business. The income that it generates is taxable income to you. The profit, right, after your deductions, of course, is taxable profit to you. That all shows up on your tax return. As most businesses, not all, but most of your practices are going to be these pass-through type business entities. So most of the businesses that are listening, or most of the practice owners that might be listening, are going to see all of that business profit end up on your personal tax return. So that's the first side of that taxation. Is the income that it generates shows up as income in some way on your tax return. The other side of that, though, is that its value as an asset, and it's if you were to sell it, let's use that. If you were to sell the ownership shares, let's say, or maybe even the assets of the business, a lot of it's going to be asset sales. Those are capital assets, and what that means is that now you're looking at the laws of capital gains and capital losses. And generally speaking, capital gains have, if you've owned something for longer than a year, a capital type asset, you can see more favorable tax rates than the rest of your income. 0, 15, 20, maybe 23.9%. So you can actually see more favorable tax rates in this capital gains world versus all of your other income. But the sale of your asset, your shares or your LLC membership or whatever it is, those are going to be within the capital gains realm. So you can see two different systems of taxations depending on the type of income that's generated from your business. And within business planning, I mean, there's a whole world of legitimate business deductions, of purchasing assets and using depreciation for your benefit. So there's a whole world of tax planning within the business. But that's sort of generally how the two different parts of that return are going to be taxed, which is not too different from other assets. So you look at like real estate, for example, the rental income, the profit's going to be taxed in a similar way by different rules, but a similar way. And if you sold the real estate, you're going to be looking at capital gains type taxation. Depreciation is a big part of real estate, though, so that's a whole other thing. And then you have the retirement accounts, which play by an entirely different set of rules, depending on the type of retirement account and that you're looking at. So I'll take a breath there. Any follow-up questions or anything like that?
No, I think the key takeaways there, Evon, is to look at this again from the standpoint of more the holistic plan and realizing that, look, there's going to be the value to any asset in your portfolio, value now, value in the future. Depending on where you are, go ahead.
Yeah, so let me tie this concept up a little bit, because I'm even starting to think about, man, like it's so broad. I can go on and on. So why is this important? Like the taxation of these different assets. Well, it's important, number one, for you think about your tax planning. You're trying to tax plan throughout your whole lifetime. Like, this isn't really a 1-year thing. You're really thinking about, okay, what is the effective tax rate I'm going to pay over my entire lifetime? And all of these different assets produce maybe income now. So it's impacting the expense you're paying now while you're working, right? And you want to plan as effectively as you can. But then you get towards financial independence. And when you start to turn those assets, you start to stop working actively, and then you turn these assets that you've built into income. Well, all of the different ways that those assets are taxed can play an important part of that financial security, because it can be a big expense in retirement depending on how well you've planned. So each of them has different tax characteristics now while you're working. And then especially as you get to financial independence, the way that you are withdrawing from different accounts, the way that you're selling different assets, all of that can play a big part in the expense that occurs as you've retired and are turning all that wealth that you have into retirement income. And so all of that should sort of be, you need to think about all of that as it sort of stacks up, both now as you're working and then down the road. It's something you should be thinking about proactively. And if there's big life events like the sale of a practice, the sale of real estate, you need to think about that carefully, about how that tax is going to be managed before you're getting to it. That's something you don't want to do November of the year that you've done it, right? You want to think about a few years before you're going to do that.
You know, you've unpacked so many key pieces there, right? It all ties back to the fact that these decisions should not be made in a vacuum, right? There's very much kind of, there's a web effect, and there's a lot of things when you're making the nudge over in this area of the web. Well, what's it doing? How's it impacting things this way or that? And whether that is taxation, whether that is total return, right? Again, looking at the practice as an asset in the context of the broader portfolio. Evon, and that kind of all, I suppose, leads it down to, man, what a great conversation. I'm realizing here we're already kind of running out of time, but do not want to end this without you sharing, what are some best practices that modern ECPs can utilize to just kind of optimize their portfolio, and specifically those who are wanting to look at their practice, or they're hip to this idea of looking at their practice as an asset and letting that inform strategic decisions across these milestones.
Yeah, I mean, when you think about, so when I'm having a conversation of what to do with extra dollars, like how to allocate resources from a return standpoint, especially earlier on in your ownership career, like you want to, I would say that practice asset is sort of the first the first use of dollars to reinvest. I mean, what can we do to reinvest into the business to improve it in some way? And I say that because from a return standpoint, when you think about both the growth of the asset as well as the cash flow that's produced from it, total return, it is probably, if successful, going to be the highest returning asset you own. That's not guaranteed, of course, but it probably will be. And it's frankly going to fund everything else, right? It's going to fund your current lifestyle. It's going to fund your future dollars you can reinvest elsewhere. So from that perspective, like that's usually the first place that I want to see dollars go to is to say, is your business fed? Like, does it have the resources, nutrition that it needs to take it to whatever your goals are for that business? And then once we're pretty confident in that, because you can't spend forever, you can't buy equipment to infinity, right? So once you've started to invest in it appropriately and you're looking for next steps, well, that's when we can start to say, okay, let's start to diversify your basically your net worth a little bit. Let's start to move some of those dollars and reinvest outside of the business and some of these other assets. And then from that perspective depends on a few different things. You know, how high of a priority real estate is in each individual's life is very different from person to person. Have you started to build up these other retirement accounts? Do you have enough liquidity in your life and just dollars you can access? So the way that you start to allocate from there changes, you know, situation by situation. But I always think of the business as sort of that first place to go to in reinvesting because from a return standpoint, especially much earlier on, you want to feed it what it can because it will likely be the thing that drives everything else, in my opinion.
Absolutely. Wow. Evon, a lot of really great pearls, really great insights here as we've been talking about looking at the practice as an asset. Fascinating stuff. So how can folks connect with you if they want to continue the conversation? And on that note, why don't you share a little about the scope of work that you guys do at Optometry Wealth Advisors?
Yeah, so we're a financial planning firm and investment management firm for optometrists nationwide. So we're working with a lot of optometrists that have either recently purchased or planning to cold start, or a lot of them usually within the first 10, 15 years or so of practice ownership. That's where a lot of the great work that I'm doing right now. And I'm really fortunate to work with them on really every financial decision or topic involved in their lives, helping them to navigate decisions around that and to be sort of the connecting piece between all their other professionals. So it's been a real joy, and I've been fortunate to do it.
Yeah, absolutely.
You can find me. You can listen to the podcast, Optometry Monday podcast. Check out on LinkedIn. I'm all over LinkedIn, so you can check me out. I think my information's down there somewhere. And then my website, optometrywealth.com.
Yeah. Well, Evon, I tell you what, man, what a really, really great conversation here. Helping us explore this whole concept of looking at your practice as an asset. Thank you all for everyone tuning in. If you want to continue the conversation, again, be sure to connect with Evon Mendrin over at optometrywealth.com. You can find Evon regular there, up there in LinkedIn world. And hey, for more great practice management insights, head on over to Akrinos.com, subscribe to the Akrinos YouTube channel, and follow us on the socials.
Take care, everybody.
On behalf of all us here at Akrinos, signing off. Thanks so much, Evon. Take care.